VICI Properties is down by 9.19% over the past year, and over the past 5 years they are up by only 16.44%, which means that they have underperformed the market quite drastically over the past year, up by only 16%, while the S&P 500 is up by 83.70%. Now, what we have to understand is that VICI is a dividend yield, and that means that they have a very high dividend yield of almost 6% with a very high dividend growth. If we go to the dividends tab and go to dividend growth, we can see that their 5-year dividend CAGR is sitting at 7.70%. So on average, they have been raising their dividends by 7.70% yearly. And so if you were reinvesting the dividends you got from VICI over the past 5 years, it wouldn't return 16%, but it would return 54.10%, which is still below the market return, but accounting for the compounding rate over the next 10 to 20 to 30 years, VICI might return much more than the S&P 500. So jumping straight to our stock valuation spreadsheets, let's figure out if VICI is a buy right now. The first thing we can see is its very nice dividend yield sitting at 5.88% with a dividend payout of $1.73. Now, one thing I don't like about the company is their high trailing FFO payout ratio sitting at 70.45%, which means that after paying out their dividends, they only have about 30% of their FFO to invest back into the business, pay down debt, etc. So let's jump to the 9-pillar analysis and see if VICI's dividend might be in danger because of their high payout ratio. And to do this, we will have a look at the long-term liabilities over the 5-year free cash flow negative dividends, which tells us if VICI generates enough FFO to cover all their long-term liabilities. And we can see that their ratio is sitting at 2.57, so they can pay off all their long-term liabilities in about 12.5 years. Generally, we want a company to be able to pay off all their long-term liabilities in 15 years or less, so VICI is doing quite fine. Now, if we direct our attention to the pillar in the middle, the decreasing shares outstanding, we can see that it is sitting in the red, and that is because VICI has been increasing their shares outstanding at a very high rate of 20.34% yearly. Now, one thing I do love about the company is that they are trading undervalued. Their 5-year price to FFO is sitting at 16.42, and currently their price to FFO is sitting at only 10.92, so investors are underpaying for the FFO of the company. VICI has also been increasing their revenue at a very high rate. They have been increasing their FFO, and they have been increasing their net income as well. Their 5-year profit margin is also sitting above average, sitting at 83.61%, which is very nice. And as we already know, they have very decent consecutive dividend growth sitting at 7.48%, which when combined with their high dividend yield of 6.83%, makes VICI the ideal company for the sweet dividend compounding effect. But now let's calculate VICI's intrinsic value, first using the historical price to FFO model, which will give us an intrinsic value of $38.34. For the second valuation model, we will use the discount FFO analysis model, where we will take the FFO over the past 5 years and calculate the average growth rate of 8.7% into the future, which will give us an intrinsic value of $37.22. Now, for the third valuation model, we will compare VICI to 3 of its competitors and get an intrinsic value of $28.47, which is basically spot on with the current trading price, showing us that VICI would be considered fairly valued compared to its peers. And finally, looking to the dividend discount model, we will plug in a projected growth rate of 7.17%, and this will give us an intrinsic value of $51.67, showing us that VICI indeed does a phenomenal dividend yield and dividend growth. And finally, moving to the ultimate valuation, we will average out these 4 valuation models and get an intrinsic value of $40.07, which is 35.74% higher than the current trading price, and with a margin of safety of 15%, we would get an acceptable buy price at $34.06, so the company would currently be rated as a buy. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.